this day. My name's Carla Giacomini. I am Director of Digital Marketing here at Alterna. I'm really excited for everybody to join, and just wanted to go through what we'll be talking about in the next hour. We're going to talk about credit scores, secured and unsecured lending, different types of lending products, and tools and tips that can help you along your on the way. And a few things I just wanted to mention before we get into it is that participants are all going to be in listen only mode. So you will have chance to ask questions. So as you can see, you can ask questions through the Q&A on the bottom of your screen. The general questions work best if there's a specific personal question to your financial situation that you would like to ask. You can actually get in touch with at alterna.ca/email or give us a call. And just want to let everybody know that the webinar is being recorded. You will have access to the webinar after the recording if you can't stay for the whole webinar. And you can just go to alterna.ca/webinar. It will be on the site tomorrow. And we will try to get to all of the questions. And if we don't, we certainly will get back to you if you leave your email in the questions with the questions. So what that means is if you don't put in a question as anonymous, that means we'll be able to get back to you. If you put it in as anonymous, then unfortunately we cannot. So let's get into it. I just want to welcome Michael Borelli. If you've joined us for some of the other webinars, you will recognize him. He's a seasoned and passionate and innovative business professional. Michael Borelli's been branch manager at our Bay Street branch for a number of years. He has over 22 years of experience in the financial sector, and he is definitely very curious and a lifelong learner. He has a great, on the personal side, relationship with his daughters, and he is their soccer coach. So he's at that every weekend. So thank you for joining us, Michael, for the webinar.
Thank you.
So we've already gone through what we'll cover. Michael's going to bring us right through the boring basics now. Over to you, Michael.
All right. Thanks. Thanks everyone for joining. So we'll get right into it. So most people, there's no shortage of opportunities to borrow money from various lenders. But do you really know the actual cost of borrowing? You know, there's many factors that come into play, including credit score, interest rates, the type of loan you seek. You know, make sure that your monthly budget allows you for a new loan or credit card payment so that you can set yourself up for success. I think doing that budget is very important to see what is within your means. Ask for help in reviewing what you can afford prior to taking the loan to avoid any issues in making payments. And so when I say ask for help, come to see a professional, right? So again, I've used an analogy from before, you know, you might know about cars and automobiles and vehicles, but if you're not a licensed mechanic, going to be very hard to diagnose things on your own. We're the licensed kind of professionals that want to help you achieve financial success. So I encourage you to come out and book appointments. While saving for your financial goals is always a sound strategy, we can't always predict the timing of our needs. Borrowing money can help you reach your goal today, allowing you to pay it back in regular installments over time. When managed responsibly, borrowing can be an effective tool to help reach your financial goals. I like this picture. And the reason why I like this picture is because on each stack of coins, there's a different life stage, or represents a different life stage. You know, and that's really one of the things that you need to consider when borrowing. Are you a student? Do you need a student line of credit? Are you preparing for, you know, maybe it's a marriage or, you know, everyday shopping, or do you like to travel? Do you need to save for retirement? Is it home buying? Each different life stage requires a different type of borrowing mechanism. And so we really want to try to highlight that for you today. Okay, next slide. So we got two main types of credit, revolving and non-revolving or installment, right? Revolving, really goes around making it's like a credit card or a line of credit where you can borrow, you pay it back, but you can still borrow against it as well. And so there's payments in regular intervals. You must make a minimum payment. You can pay more on there, but typically the minimum is going to be 1% or interest only. So you have to have a real strong lens on how you use that money. Installment or non-revolving credit is where you make scheduled payments, and those payments typically include interest. You can't re-borrow. So those are like a loan or a mortgage. You pay, and there's a reduction in the limit or in the balance, and you can't borrow again from it. So really, the questions to ask yourself before turning to credit is, am I able to use this credit wisely given my current financial situation? Will using this credit create good debt or bad debt? And we'll talk about that in a little bit. And will this credit support my personal needs and values? See, when we say about can I use this credit wisely, many times with many members that I've helped, they're not able to use credit wisely. They use it, they just pay the interest, and they use it a little more, they just pay the interest, and they get into this perpetual kind of borrowing and only paying interest and not reducing the principal. Some people are better than others when it comes to that. So you have to know what type of person you are. Using a credit card is a great financial instrument to use, but only if you use it in the right way. Um, you know, Think carefully before turning to credit as your means of financing a purchase. Is this a need or is this a want? And we talked about that in our savings and budgeting seminar as well. Would you be better off saving cash for the purchase over time, or do you need to make the purchase sooner? So I'm going to go to the next one. So there's two types of loans that you can receive. So there's secured loans and unsecured loans. I'll start with the secured one. Secured one is a secured loan or line of credit is backed by something that you own. So it could be a home. Typically, it's a home. It could be a car, but it would need to be a pretty decent car to be able to secure a loan against it. And when you agree that that lender, can use that as collateral, then if there's a non-payment that happens over a period of time, then that, the institution can repossess that property, right? So it's important that you kind of know whether you're able to secure or not. These loans are typically offer lower interest rates as the risk to the bank is lower. So typically, if you have a big purchase, you may want to consider a secured loan because it's going to have a lower interest rate. Unsecured loans or lines of credits are not backed by a collateral because the lender trusts your ability to repay the loan with your own financial resources. And so they don't require a collateral. However, it might be a higher interest rate, and it might be a little bit riskier for the bank because it's unsecured.
Okay, great. That's great. Great info. We're going to start our first poll. We really want, we want everybody involved. So the first poll that we're going to launch is about, the how do you prioritize? You probably see it on your screen. How do you prioritize the features when considering a new credit product? And if you could rank them from 1 to 5. 1 is the most important, and 5 is the least important. So, is it loan term, fees, loan amount or credit limit, interest rate, introductory offers? Sometimes you get companies offering, some little carrots there for you to come in and take a product, right, Michael? We we know about that too, right?
That's right.
Yeah. So just give it a couple of seconds, let people um, put in their answers, and then we can let Michael take it away.
Yeah, I always find the answers very interesting. Very curious to find out what people are thinking.
Yeah, yeah. So definitely looks like from what I'm seeing, fees and interest rates are coming up as the top the top definite interest rate is the top, Michael,
Yep.
and, followed by fees, right? So,
And I mean,
yeah.
again, like interest rate is very, very important, of course, but I think in order to make the best type of decision, you need to know all the variables that are in play, right? So of course, interest rate is going to be at that top, but does it matter how long do you want to pay this off? And when it comes to fees, on unsecured products, there's typically no fees with unsecured lending products. When there's a secured product, there's typically fees involved because you have to register them and there's different third parties that are involved in registering the product, right? So that's why there's sometimes a little bit more cost to it. When we look at the total cost of borrowing, it's important to understand the different terminologies around it. So the principal, as an example, is the loan amount, the amount of money that the bank is lending you, and is often referred to as the principal loan amount. When you borrow money from a financial institution, you repay the principal amount plus interest charges, right? When it comes to interest rate, there can be a fixed interest rate or a variable interest rate. Fixed rate loans feature an interest rate that will never change during the loan's term. So if you take out a 5-year loan at whatever, 9.99%, that's going to stay for the entire 5 years. So that also means that your payment won't change while you have the loan. And sometimes people like that as a peace of mind additive. So I'm the type of person that I really like to know what my payments are, and I like to have a fixed payment schedule, right? So I know I can build it into my budget. When it comes to that revolving or variable interest rate, things can change quickly. So sometimes you might pay an extra $10 or $20. Sometimes it might be even more than that. So it really depends on the type of person that you are. The variable interest rate can fluctuate monthly or quarterly, based on the Bank of Canada's prime interest rate. If the interest rate falls, more of your payment is applied to reduce the principal. If the rates go up, more of your payment is applied to paying interest. So when choosing between the two, explore your options and the state of the market to determine which option benefits you more. So interest rates, usually shown as an annual percentage rate, is the amount the lender charges you for loaning the funds. This percentage is based on the amount owed on the loan and is added to the total amount you need to pay by your given due date. The loan term or the amortization is the length of time you have to pay it back. It can range from a few months to several years, depending on the type of loan you take out. If you shorten the term of your loan, your monthly payments will be higher. But if you pay less but you also pay less in interest in interest charges over time. Sometimes you want to watch how much you put towards your loan and how much your loan term is, right? We all have great intentions to pay off our loans very, very quickly, as quickly as possible, but you also don't want to neglect some of the other saving features that you want to include in your financial plan, right? You want to also save for today. You want to save for maybe tomorrow or retirement. And you also want to include that debt repayment as well. So you have to manage that. And that's why we encourage you to come and see an advisor to help you plan it out a little bit better. If you take out a loan with a longer term, then your monthly payments might be lower, but you'll incur more interest charges over the duration of the loan. So you really have to balance what's best for you. Do I need it now? And do I need smaller payments now? Where it might cost me a little bit more in the long term, but I can manage it now. Or do I want to pay it off sooner, so then I'll have more relief later on? So understanding the specific features and terms of each type of loan will help you choose the one that's right for you.
Michael, we had a question come in from one of our members
Yeah.
regarding the unsecured loan, which you spoke about. And they're asking, is there a minimum amount granted for an unsecured loan?
So every financial institution is a little different. I believe ours is at $1,000 for the lowest amount for a loan.
Okay, perfect. Great. So now we can understand what all about credit. We always get a lot of questions about credit history, credit scores, and all that. So take us through this.
It's an interesting one. Credit is not always understood out in the marketplace, and it has a huge bearing on your ability to secure funds from a financial institution. When you need to borrow money, lenders typically run a credit check to help them assess your risk. A credit score is one tool that we use to see how much risk we're taking by lending you the money. So when an institution lends you a money, it's a promise to repay, and it's based on various factors. A high or good credit score might indicate that you're a good potential borrower. A lower score might indicate more risk, so the lender may give you a higher interest rate to offset some of that risk. Maintaining a good credit score by managing your credit responsibly can help you increase your chances of securing a loan. So if you've already borrowed in Canada, you have a credit report. And there's two primary credit bureaus in Canada, Equifax and TransUnion. I would highly encourage you, if you haven't seen it recently, and even if you're not borrowing funds, to request a copy of your credit report every year or every couple of years. You need to have a good understanding of what's on there. It's also a good way to mitigate fraud, because sometimes, if fraud is happening in the background, you might not know until it's a little bit too late. Important that you have a good handle on your credit situation. So it's a free credit report. Go to Equifax, credit report, and then we can help, analyze it for you as well. On the report, it lists open loans and chronicles your payment history, which defines your credit score. The higher your score based on responsible use of credit, the lower the interest rate. Missing payments, opening and closing numerous credit cards, or carrying higher balances on credit cards can affect your score and ability to secure a lower rate on your loan. Your credit report helps you to understand your financial habits and how that affects your score. If you see incorrect information, another reason why you should get a yearly report. If you see incorrect information, that could be a warning, a sign of potential identity theft or credit fraud, or they just have it wrong and you need to kind of correct it. So each person's credit report includes the following information: your personal identity information, like a SIN number, your credit history, any kind of public record. So meaning if there's you've been taken to court, or even if you're taking somebody to court, or if the government has some comments on there, we're going to see that. Your report inquiry. So the credit report also sees how many times you've applied for any type of credit facility out there. And then also some dispute statements. So if you have found an inconsistency in your credit report and you're going to be fighting that, that's going to be on there too, those messages, which is important because we need to see that. I'll go through some quick stuff about credit rating. And so R rating is the most common for revolving credit. Other indicators are I for installment credit, or O for open lines of credit. So who uses these credit ratings? The financial institutions, of course, credit card companies, believe it or not, your utility companies, maybe a Union Gas or Enbridge or things like that, a wireless phone provider, and any other asset lenders out there. So it is really important that you have a good handle on your credit score and start good habits now. So, what is a credit score? It's the number based on the information within your credit report, based on a scale of 300 to 900. So if you're at the higher end, it's going to be better. An average credit score is around 700. And so if you're below that or well below that, there may be an opportunity to start building that credit back up. If you're above that 700, you've been doing a great job and have ability to borrow in the future if you need to. So when authorized, credit bureaus allow organizations to see the score and determine the financial risk in dealing with each member. We also use it to help qualify a person for a loan and determine what interest rate will be charged.
So it's interesting, Michael. There's always a lot of questions around
Wow.
credit score, and
Oh, yeah.
yes, we have one from one of our members looking for some tips on how to improve credit score in a 6-month window. What are your suggestions
In a
there?
6 month window. See, like what happens is that all types of companies, it really depends on how quickly they report it back to the credit union or to the credit bureau, right? And so some do it on a monthly basis, they report it back. Some do it on a 3 month or quarterly basis. Some people do it semi-annual, or some organizations do it semi-annually. So it really depends. In a 6 month window, what you could do. So first of all, you have to pay your bills, right? On time as much as possible. If you're also at the highest utilization, so say it's a $10,000 credit card and you're at 9,999 consistently, that's going to hurt your credit score. So what you want to do is bring it there. You don't want to have underutilization or overutilization. There's a meaty middle in there where you're using it, but you're not desperate to use all of it, right? Because it comes, if you do lots of credit inquiries. So you go to Rogers, make a credit inquiry. You go to Alterna, make a credit inquiry. You go to one of the 5 big banks. You go through a car company to get a car loan. The more inquiries you have, it looks like you're desperate for credit, and that will hinder your scores as well, right? So there's a fine line. So things to do is make your payments on time, keep your limits within reason, right? That's also very, very, very important. Um, you know what? I have a couple of other ones that and I'm actually going to speak to it a little bit more on a couple of other slides too.
Okay.
So if that's okay,
Yeah.
Carly?
Yeah, no problem. Yeah. Yeah, no, I think that was great. Did you want to go through the personal loan requirements here now, or
Yeah, of
you
course.
want me to?
So
Okay.
yeah, of course. So when you're doing personal, some of the requirements that lenders consider for personal loans are the credit score and the history. So you give us authorization and consent to pull the credit bureau history and score, and we're going to have a good understanding of your credit worthiness, right? This is what it kind of looks like, and your ability or your promise to repay that loan back. The second piece is going to be income. And so income, it has to be more income than debt out there in order for us to lend more credit to you. So there are some specific rules around that, and there's some total debt serviceability that we include. So that's part of the application process. The net worth piece, institutions look at what do you have to fall back on. And so what net worth does is strengthen the application for your loan or unsecured lines of credits or credit card. It strengthens it. So what you can share with the institution is important, because we can say, okay, look, there is a savings nest egg, a TFSA, a savings account or something like that, where this strengthens this person's ability to pay it back. So the debt to income ratio, number 4, is really about that income. You just for an example, as an example, if you're making $60,000, but then you have debt of 40,000, it's going to be more difficult the higher the debt is based on your income. So there's a ratio that we work within that the government prescribes to us to ensure that lending is not risky, right? In other countries, as an example, right, they're not centrally governed. So they don't have some of these requirements. So they just lend as, you look good, I'm going to lend it to you. Then they put themselves into big trouble. So that's what we see sometimes in the States, because they're not centrally governed. So in Canada, we have a great system in place to ensure that we're not overextended. Number 5 is the collateral piece. And so if there's an ability to secure something against a loan or a line of credit, that's going to lower the interest rate. And the origination fee here, That's going to be typically for secured lending, not so much for unsecured. So if it's a personal loan or if it's an unsecured line of credit, typically institutions don't charge for that. If it is a secured loan or line of credit, such as your house or your car, there's going to be some fees involved with that. Small fees, but something there.
Great. So we talked a little about credit score, right?
Yeah.
And the numbers behind that.
Yes, and so again, we talked about going from, between 300 to 900. This is a great representation of what it looks like to be having a poor score or below average to a good and excellent score. So it's a three-digit number, and it's indicating the likelihood that you will repay the borrowed money. It's a crucial factor used by lenders such as banks, credit card companies, and mortgage lenders to evaluate the risk of lending money. And so a higher credit score makes it easier to qualify for loans and credit cards, often with more favorable terms, such as lower interest rates. Monitoring this credit score is important. And so I would highly recommend, again, if you haven't done it, go on to equifax.ca or even TransUnion and pull that. It also helps to mitigate fraud, right? And as I mentioned, so for example, a few years back, I lost my wallet, right? Then I saw somebody use on my credit card. They used funds off of my credit card. One of the first things I did after I canceled the credit card and worked on the fraud situation was I registered with Equifax for credit monitoring. It was $20 a month. It was important for me to see what was happening to my credit. And also what it does is that it will alert you if anybody is doing any kind of fraudulent activity under your name. And so I think I did it for the whole year so that if anybody had my ID and copied it and used it, went into an
Yep.
institution and tried to borrow funds, I would be alerted, before anything happens. And so I would absolutely recommend that you get into that for sure.
Yeah, that's a great tip with all the fraud that's going on,
Yeah.
that we hear about today. And then,
When we go
some of
into the next, yeah, so what
yep.
affects my credit score? And this is also going to help to address what can I do to get my credit score back up there, right? So again, credit scores are typically calculated based on various factors. So payment history. This is the record of your payments on credit accounts, including credit cards, mortgages, and other loans. Late payments or defaults will negatively impact your credit score. So in order to build up your credit as well, make payments. Make those at the minimum, make the minimum payment. Your credit utilization. So it reflects the percentage of your available credit that you're currently using. Keeping the ratio low is generally considered favorable. So again, if you have a $10,000 line of credit and you're always at 9,000, 9,000, 9,000, you're just paying the interest, it's going to hinder your ability to get future funds. Also, though, if you have a line of credit and it's always at a zero balance, you're never using it, that doesn't help you either. It might not lower the score, but it will be questioned or looked at. Why do you have it and why aren't you using it, right? And so you have to kind of get into that meaty middle part of the credit utilization. Another factor is the length of credit history. So the longer your credit history, the better. It allows lenders to see your borrowing and repayment behavior over an extended period of time, right? So everything is patterns, habits, and behavior. So a longer credit history is going to give us a better idea of your ability to repay these loans. Also, another consideration that affects your credit score and also to how to build it up is the type of credit in use. So it considers the various types of credit you have, such as, do you have a diverse financial instruments such as a credit card, mortgages, and installment loans? Because a diverse mix can positively impact your credit score. As an example, if you only have credit cards, lenders are going to start questioning that and questioning, why are you doing that, right? Like, it doesn't make sense that you would have only credit cards at a high balance. You're paying a lot of interest. There's red flags that kind of come up. And the last one that can affect your credit score is new credit. So opening multiple new credit accounts in a short period of time can be perceived as risky behavior and may negatively affect your credit score, right? So you have to think. So say I'm buying a new car. I'm not sure what dealer I'm going to go to. So I'm going to go to this dealer. I'm going to do an application. I'm going to go to this dealer. I'm going to do an application. I'm going to do this deal. That's not sound. I wouldn't give you that advice. You really have to think about before something you give consent to pull your credit bureau. Really think about how many times have I done this year? I
Okay,
don't know if
great.
there's any more questions on that one, Carla, or we can move
Yeah,
on.
there's always a lot. Let's let's keep going. There's always a lot of credit scores, so let's keep
Right.
going because we're at
Okay.
half of the hour.
Yep. Uh, so,
Yeah, I think
and I mean,
you
here's
talked to
how do
yeah,
I
you
improve
talked to
it,
some of
right?
these already. Yeah,
Yeah,
yeah.
but check your credit report, right? Do that. I would, write it down and make it, make it a priority this week to check your credit report. Pay your bills on time, right? Reduce your outstanding debt. If lenders see that you're making an attempt to try to reduce those principal amounts, that's going to really help to better your credit score. Avoid opening too many new accounts. Build a positive credit history. So maintaining older credit accounts as the length of your credit history influences your score. If you have a limited credit history, consider becoming an authorized user on someone else's credit card or applying for a secured credit card to start building it. So if you're saying to yourself, I don't have any credit, and so how do I build my credit? Think about a secured credit card, right? So if you have $1,000, put $1,000 aside and open up $1,000 credit card, use it responsibly. That's how you're going to start to build from there. Diversify your credit mix, as we just talked about. Work with the creditors, so such as Alterna. If you're struggling to make payments, contact us so that we can discuss possible solutions. There might be a consolidation loan that we can look at to help you. It's much better to get in front of it. Don't be embarrassed. Come and see us. It's better to work with us to find a solution than rather reporting late payments. Another thing to put to note is to be patient. You know what? I would love to say that in 3 months you can turn that around. It's going to be difficult. It is improving your credit score is a gradual process. It takes a little bit of time to establish a positive credit history and demonstrate responsible financial behavior, right? So 6 months might be on the very, 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 very low end, but I would say it would take approximately a year or so to start demonstrating those responsible financial behaviors. And of course, seek professional advice.
Thanks, Michael. One of our members, Andrew's asking, who should they contact to obtain their credit score? So I think you said TransUnion and Equifax. Those were the
Yeah.
two that
I
you
mean,
recommended.
TransUnion, it really depends on what the organization uses, but I will say that majority of financial institutions and lenders out there use Equifax. So my recommendation personally would be to go to, Equifax.ca. There is a free credit report. I think it's limited in what you can see, but it gives you a good idea of what it is. And you know what? If you've never done it and it's $20 to pull a report, like the full report, I would do it. Power is knowledge, and you can only make better decisions if you have all the information in front of you. So I think
So
that's
that goes to another question that we had from one of our members asking, if you pull more than three, I guess, reports from different companies, could it harm your credit?
yeah,
Right? Is pulling
it
reports?
can. Like I
Yeah.
can't say that it's a specific number. Is it three? Is it four? Is it
Right.
five?
Yeah.
But I can tell you though, if it's subsequent pulls in a very short amount of time, yes, it'll lower your score. So maybe it goes down by 3 points, 3 points, 3 points, each one, right? I've seen so many different types of credit reports in my time, and you can tell right away which ones are just seeking credit. Which individuals are just going out there seeking credit. And then I guess the question would be from the lender is why? Why are you seeking so much credit? What's the intent here? And what is then, if you have all this credit out there, am I going to get paid back? And so
Mhm.
sometimes we look at it like, okay, if you were to lend your own money to another individual, what would be the criteria? How would you determine the likelihood of that person paying you back? So for example, if I'm lending to somebody myself personally, and I'm lending to somebody, and I know that that person owes 10 other people, do I feel comfortable now lending it to them because I might not get paid back? That's kind of the general idea of how that works.
Mhm. Okay, great. We're going to go into another poll now. Again, we would like to hear from you. It's all anonymous, so no fear there. Ian's going to launch the poll for you. The question is, how do you actively manage and monitor your credit products to ensure financial stability? So again, a little more of what Michael talked to. Like you can choose any that apply to you. Do you regularly check your credit score and report? Do you actively pay off outstanding balances? Do you seek professional advice? Do you review and update credit limits based on your situation? Do you set up alerts for credit card transactions to let what your balances are and what have you?
Mhm.
So just give it a few seconds here. Definitely, everybody is paying out their outstanding balances as number one, for sure. So that's a great habit for sure, right, Michael?
Hey, some
And
very savvy borrowers here.
yeah, yeah, and then followed by setting up alerts, which is great, right?
Yes.
Reminders that come automatically that kind of let you know where they are. So yeah, so those were the two. We can share the results. You can see
Yeah,
87%. Yeah,
with these ones, Carla, like I mean, actively paying off an outstanding balance is
yeah,
great. And we
yeah.
would highly recommend, if it's a credit card as an example, typically you have 21 days grace period before you need to pay it back. Why not use that option? But, the key is to pay it back. However, the one thing I would say is that not everybody has that ability, right?
Sure,
To
absolutely.
pay the full balance off. And so there's different things that you can do. It's interesting that the lowest thing was seek professional advice for
Right,
credit
that's what I was surprised at as well.
strategy.
Yes.
Sometimes I think some of that is because we're embarrassed. I have a lot of credit. I don't know what to do. I don't want to
Mhm,
tell, other people in my family or my friends and stuff like that. And I just keep it secret to myself. What I can tell you is that talking to a professional for advice is important. It gets you to talk about it, and sometimes talking about it out loud will help to find a solution.
mhm.
It's important. I would love to see that number to go up. Setting up alerts for credit card transactions and accounts, and reviewing and updating credit limits based on changing financial situations, and regularly checking your credit score. Important stuff. One thing that I will say that I notice not a lot of people do, which I find unbelievable, is that they don't look at their finances,
Mhm.
right? Like you should be checking your credit card statement or even on your mobile app all the time, at the minimum once a week. Now, I work for an institution, so I'm looking at it a lot more but I'm looking at it, A, to make sure I'm staying within my budget and seeing what my spending habits are, but also B, very important, is to mitigate fraud. You'll know right away if on a credit card, right? Whether there's something is up. So
Great
it's a
tips.
good
Yeah,
one.
for
Yeah.
sure. Great tips. Okay, now we're going to talk about the different types of loan products. You'll take us through that.
Yeah, so loan or credit products allow individuals to borrow money on the understanding that it's going to be repaid in the future with interest. And these products play a crucial role in providing us with the means to make purchases or investments without having to pay the full amount up front. So when we go through the examples of loan options include, and again, you may know about this, you may not, so I'll cover them all here. So mortgages. This is considered good debt, right? So loans for purchasing real estate where the property serves as the collateral. So the features of those are long-term repayment, because you can amortize it, between 25 to 30 years, depending on your situation. It can be fixed or adjustable or variable interest rates. So there's a lot of different options when it comes to a mortgage, but we're very lucky in Canada that we have the ability to get a mortgage, based on some of the income and good credit scores. There's personal loans. So a personal loan is considered an unsecured or secured loans for major purchases like a home rental or a car. An investment loan, sometimes people will take out money in a loan, put it in an investment. The investment, say, for example, is making 8%. My repayment interest is at 4%. So I'm making money. Sometimes people have that. I would advise, if you do have interest in that, talk to a financial expert to help you. As an example, I took out an investment loan to help me maximize my RSPs. Right. So when I was a first-time home buyer, I took out an RSP loan to put money into my RSP, so then I could take it out to have a bigger down payment for my home. And so again, there's so many different options, and you might be saying to yourself, well, what does that mean? That sounds, I'm interested in that, but I don't know what that means. Come and see us, and then we can get into some of the more details through undivided attention. There's home equity loans and lines of credits. So a home equity line of credit is secured by the house, and it's based on the income or the equity that's been built in your home. And so the reason why, typically, if you're a homeowner, we ask about a home equity line of credit is because it's secured against the home, and it's a much lower interest rate than a personal loan. There's, of course, lines of credits, and the difference between a personal loan and a line of credit. Personal loan is an installment. It's a term reducing loan, right? You get 10,000, you make your monthly payments. At the end of it, zero, and it's paid off in 5 years. A line of credit, however, is credit limits that a borrower can draw from as needed, pay it, and draw from it again. It's an open revolving credit facility. And some of the key features there is that it's flexible borrowing and flexible borrowing interest on the amount used. So again, you don't have to pay for it unless you use it. If you use it, you might have needed it. Lastly is the credit card. So credit cards allows card holders to make purchases on credit. Like I mentioned, typically it's 21-day grace period. So you don't have to pay that back you don't have to pay back with interest within that 21-day period, right? It's something that'll help you pay now or buy now, pay later. But I would highly recommend that you're diligent in making those payments, because a lot of the times people get stuck in this perpetual circle of, I'm just going to pay the interest. I'm just going to pay the interest. I'm just going to pay the interest. That balance stays there and you're just paying interest, right? And so sometimes when you get to the point where you're just paying interest, again, that's where I would, go into a financial institution like Alterna, come see us, and then maybe we have a different option. Maybe we got to turn that credit card amount into a loan. And so because you're just paying interest, maybe we do a loan, 5 years, it's paid off, and reduce or even remove that credit card limit. So it's important for individuals and businesses to carefully consider their financial situation, terms, and interest rates before choosing and utilizing credit products.
Okay. So we're going to just go on to a little more on each of the products now,
Yeah.
Michael.
Okay, let me just see timing. Okay, we're pretty
Yeah,
good.
we've got pretty good. Yeah, and I've got a few more questions, but I'll hit them when you get to the slide.
Yeah.
Yeah.
Okay. So when it comes to mortgages, mortgage eligibility depends on various factors, and lenders typically consider several key criteria when determining whether to approve a mortgage application. Common factors include credit score. So we talked about that, right? So that's one thing you give us. That's one of the first things that we do is we pull a credit score report. If you're on the lower or below average, it's going to be difficult. If you're within that good average or good or excellent, that's going to be a big check mark. Income and employment. So lenders want to ensure that you have a stable income to make monthly mortgage payments. We typically will have to verify your employment history and income stability. We do that through pay stubs, letter of employment, year-end T4 slips, and typically, most importantly, your notice of assessment, so your tax returns for that year. We consider debt to income ratios. So we calculate your debt to income ratios by comparing your monthly debt payments to your gross monthly income. So a lower debt to income ratio, indicates better financial health and may increase your eligibility for a credit product. For a mortgage, we also consider the down payment. The amount of money that you can put down as a down payment can affect your eligibility. A larger down payment often results in better loan terms and may make you a more attractive borrower. Then we have loan to value ratio. So this ratio compares the loan amount to the appraised value of the property, right? And so lenders may have specific loan to value requirements, and a lower ratio can improve your eligibility, of course, right? Institutions don't do 100% loan to value. That's very, very risky, right? Employment history, so consistent employment. Residential history, lenders may review your history of residence to assess your stability and reliability. Assets and reserves, so having additional assets such as savings or investings and financial reserves can strengthen your application. The type of employment, so, is it full-time? Is it part-time? Is it contract? Do you get paid a salary? Is it hourly? Things like that. And then legal and credit history. So that, legal stuff will show up on a credit history typically. Bankruptcies are going to have a huge effect, or significant negative events could have an impact on your eligibility.
And then one of the pieces there that just want to let everybody know that we do have some calculators on our website. If you go to alterna.ca/calculators, we have a mortgage affordability calculator. So it'll help you determine how much you can afford in a home. And there's also a mortgage payment calculator. And if you want to just scan the QR code, that'll bring you directly to the calculator.
Yeah.
So that again, trying to use all the tools at our disposal, right, Michael?
Well, absolutely. You have
Yep.
to, because
Yep.
again, that's for anything though. It doesn't have to be just
Yep.
finances.
Absolutely. Absolutely.
So
So just like, yep.
yeah, we've covered a little bit of loan versus line of credit. I'll just, reiterate that a loan is pretty straightforward. You borrow the money, and you're expected to pay it back with interest by a certain date, and end of story, right? That's what it is. A line of credit is different. It's more like a bank account where there is a defined credit limit, but it's very accessible, like an extension of your checking account. So there's no repayment deadline for the full amount. You just have to make a minimum monthly payment. Sometimes that minimum monthly payment, it could be interest only. So you open up a line of credit, you use the balance, and you'll just pay your interest. That balance is going to stay there. And you're just paying the interest off, right? So it's a great product to include in your financial toolkit. It's often used to help individuals manage personal expenses, navigate financial emergencies, or lower interest costs by transferring balances from higher interest cards. So again, sometimes people have a credit card and they have an unsecured line of credit. If they have a balance on a credit card, they can move it over to the unsecured line of credit at a lower interest rate. So it can provide, a line of credit can provide flexibility, a higher credit limit typically, and access to available credit. So those are kind of the difference.
Okay, great. Talk a little about home equity loans.
So a home equity loan or home equity line of credit, the interest rates are typically lower than any other facility that we have, but lower than credit cards and other types of unsecured debt. But they'll probably be higher than your existing mortgage rate. So the lowest type of rate that you can get is going to be through a mortgage. It's term reducing. Once you take out that mortgage and you get that amount to purchase your home, you pay and it starts to reduce. You can't re-borrow from a mortgage. Then goes the home equity loan or line of credit. That's going to be a lower interest rate than any unsecured credit, but it's still going to be a little bit higher than the mortgage.
Hmm.
Okay. Because lenders see second mortgages, because a home equity loan or line of credit is kind of like a second mortgage. We see it as riskier than the first mortgage, right? The rate lenders offer will also depend on factors like your credit rating and overall financial situation. If you can't make your mortgage payment, and your home is seized or sold, your original mortgage is paid off first, then a line of credit. So that's why a home equity line of credit is at a higher interest rate,
Okay,
but
great.
very good for flexibility. So for example, if you're doing a home renovation,
Yeah.
that might be something that you're going to utilize because you don't know when you need to pay. You're going to pay this contractor, you might pay this person at a different time and this one. And so there's a lot more flexibility. Again, each one of the credit facilities that Alterna has, for example, and all financial to has a place in your financial toolkit for sure.
Great. Okay, we're going to go on to credit cards, and there's a couple of questions, but I'll leave them till the end
Yeah.
on the credit cards.
So you'll often receive offers for credit cards with low introductory rates, and I say introductory rates specifically. Make sure you read the fine print on those deals because credit cards often readjust to much higher interest rates when the promotional term expires. And so that adjustment can cost you a lot of money based on the balance that you carry. Also, simply opening a credit card will impact your credit score. Small amounts, but it will. So be judicious in that. Credit cards are widely used financial tools that allow consumers to make purchases on credit. When you use a credit card, you're essentially borrowing money from the card issuer to pay for goods and services. Each card comes with a specific credit limit, what you can qualify for. They may offer convenience and flexibility in managing expenses, and they often come with various rewards and benefits. So you really have to think about what's in your best interest. So, for example, if you're a traveler or you have intent to travel, probably a travel credit card is best for you because after years of saving up points, you can use it and it helps. So I use myself as an example. I never really needed a cashback credit card. That didn't interest me personally. I was interested in a travel card. So we've gone to Italy and Portugal a couple of times. And we just saved up our points. And you knock off 800 bucks, 900 bucks each time we go out. And that might cover some of that flight costs, right? So it's important. So the card issuer charges interest on the outstanding balance if not
Mhm.
paid in full by the due date. So it's important to remember to use these credit cards responsibly to avoid accumulating excessive debt. And so if you do find that you have a credit card that you're at, maximum utilization, you may want to consider coming in, speaking to a professional advisor to think about what are my best options, because just paying the interest and just kind of keeping in that circle is probably not the best thing for you.
Great. And one of the things that we just wanted to, there was a question on balance transfer and some card offers that we have. So we do have on our Alterna savings Visa cards, 0% balance transfer offer for 9 months. So one of the questions was how to reduce higher interest. So you could then move your balances from other credit cards if you do open one of these. And there's also $5,000 welcome points. So
Yeah,
you
like
can,
that
yep,
zero. Yeah, that zero interest balance transfer, to be honest, and I've been in the financial industry for a long time. It's been rare where I've seen zero interest.
you're right. Yeah,
Okay,
yeah.
usually it's like a
Low.
0.99,
You're right. It's low. Yeah.
1.99. I've seen a lot of 1.99s out there.
Hmm.
It's been a long time since I've seen zero interest on a balance transfer. So for example, if you have one of the five big banks credit card, you can open one up with Alterna, transfer that over for the 9 months, and now you have a new plan on how you can pay back. So in 9 months, you can start really
Hmm.
hitting towards that principal, right? And so
Yep,
I would recommend
absolutely.
it. The other thing that I'll mention also is retail credit cards. So retail credit cards like a Home Depot or a Canadian Tire or whatever it is, those are at the highest interest rates. If you notice that if you don't make a payment, for example, it could go all the way up to 27%. I've seen 27% on a Home Depot credit card,
Yeah.
right?
And there,
Yeah,
Yeah.
sorry.
No, sorry, there was a question that and I thought it was interesting. They're asking if you can move 2 credit card have you do different credit cards over to consolidate into one in this balance transfer offer.
I think you
Yeah.
can.
Yeah, yeah,
I
so,
think you
yeah,
can, right? So
yeah, yeah,
that's a great question, and I will
yeah,
say that you can come in. We have the process in place here, so that will help you to do all of that. But holding a balance on a credit card, not the best thing for you to do. Better to hold a balance on an unsecured line of credit because it's a lower interest rate. Even better to hold a balance on a home equity line of credit if you have that opportunity. And if you're able to put it all into a loan, a term reducing loan, and pay it off in 4 or 5 years, that's going to be your best option.
yeah. And so, you can also visit alterna.ca/offers to learn more about the cards, or as Michael said, book an appointment or give them a call.
Yeah.
So Michael already hit on this, the value of financial advice. So if you do need to speak to anybody at Alterna, you can definitely book an appointment. Call Michael. We have all his details. But if you're looking at figuring out how to consolidate some debts that you have, or really just need to talk about anything from a financial perspective, really we're here to help. Um,
And I would
couple of
say that
yep,
that's also one of Alterna's what the difference
absolutely.
is with Alterna is exactly the last thing that you said, Carla, is
Hmm.
even if you just have questions and it's not
Right.
about a certain product or service or you're trying to get something out of it, just to sit down with somebody, hey, can I bounce this off of
Hmm.
you? Can I get your advice on this? Like
Right.
that is invaluable to me. I would say to you that the other institutions, they typically don't have the time or do that personal touch. That's where the alternative difference comes in, right? Like there's
Yep.
not going to be any kind of pushing of anything.
And
If
there's no cost to come and see and talk to
and
you.
there's no cost to
No
come and see it.
cost.
We truly care about your financial success and educating you, providing you that financial literacy. It's so that you're armed with all the information to make the best decisions for you. So again, it takes 1 hour to come in, right?
Yep,
Like we do all
absolutely.
these other things. We do all
And
these
you don't even have to come in, right, Michael? Like you can have a video conference, right? Like you
absolutely
don't
we can do it
physically have to
virtually
come in.
too,
Yeah,
right?
exactly.
You
Yeah.
see, you go to the dentist, once every 9 months or a year. You go see your
Mhm.
doctor regularly. You have to get your oil changed every
Mhm.
5,000
Yep.
kilometers, right? So why aren't you coming into
Tune up
Alterna
your finances.
to check your finances
Yep,
out? If
absolutely.
you find yourself looking back and saying, "Hey, I haven't been to the bank in a long time," yeah, come and see us.
Right, absolutely. And there's some other online tools that can help you. We've got calculators, there's loan calculator, mortgage, and prepayment. We talked about, we've got a lot of blog articles. Michael talked about life stages, a lot of articles on different life stages and what, great information there. And we also have a budget planner at alterna.ca/budget planner. So if we've got a lot of tools on the site, make use of them for sure and come and talk to us. We can help you out. We also had another question from one of our members that was asking about the prime rate. So we have
Yeah.
rates on our website. Go to alterna.ca. The prime rate right now is 7.20, but you can go to the website anytime and check out all of our rates, alterna.ca.
Yeah.
And we also have two upcoming webinars. There's a TFSA versus RSP on March 21st at 3 p.m. So it's a deep dive into the advantages of each. And then there's a home buying. So if people are looking either to switch or to buy a new home, what have you, that's April 16th at noon, right? So we have those two. They'll be set up. You'll be receiving an email and you can register for those as well. And we're here for you, as Michael said. His contact information is here. You can actually scan the QR code if you wanted to book an appointment, or you could call him as well or email him.
Yeah.
And either a virtual or in-person appointment, he'll be more than willing to answer your questions. There were quite a few questions. Um,
Mhm.
Sorry, Pierrette is asking about can you put the QR code back? Which one? I don't know which one, Pierrette. But what we can do is this is going to be live on our site tomorrow, so you'll be able to go and view it, and then you can get the QR codes for any of the pages that you're looking for or information that you're looking for. Right. So we are at time. And what I'm going to ask everybody is if you had a question that wasn't answered, we will respond to you, but only if you provided your name. If it came as anonymous, unfortunately, we don't have your email address in order to send you the response. So if I'll give you a minute or so, if you do want to put in a question with your email address, if you had previously put in as anonymous, please do so. And I really want to thank everybody for joining us today. I think it was a great discussion. We always have a lot of great questions. Michael's always got a lot of good insight into any financial space. I find whether it's borrowing, whether it was savings. So we'll have more sessions with Michael coming up. So stay tuned for those. I do want to let everybody know we will be sending out a survey after the webinar. And it's short, it's literally 5 questions, should take you no more than 15 seconds to answer. And what it helps us do is understand the types of topics you're looking for and that we can bring to you. So it does help us for our future content. So thanks again. And thank you, Michael, so much for
Thank
being
you.
part and hosting the webinar.
Thanks,
Thanks,
everyone.
everybody, and everybody have a great afternoon.
Bye-bye.